Well, we've got three massive pieces of housing data that are out, and you've got to know about these, whether you're watching this now or you're watching this 3 months from now. The data that you're going to learn here and the information in this is going to help prepare you for where to go shopping for real estate when this market continues to crash, because I'm specifically going to go through some locations that are really getting hurt the most. We're going to break it all down. Folks, I just want you to remember, back in January, remember how we talked about how the bad part of housing prices falling isn't that housing prices are going to fall, which we knew would have happened. We knew prices would come down because rates were going up. That was simple. Like, my 7-year-old could have told us that. But the real problem is not that rates are pushing prices down. It's that prices going down leads to media coverage of prices going down. And the fear that goes along with that is painful. That is when you get real price declines. See, you've now got Bloomberg running headline articles saying things like, say goodbye to the housing bull run, and Barron's running headlines with, quote, the 7% mortgages are near, and they're basically here now, especially with the movements in the 10-year today. And don't even get me started on Zoomtown. Zoom is now being blamed for 60% of housing price increases in certain areas, and just wait until this reverses. But fear, folks, fear is what leads to cancellations and pauses in purchases and the collapse of homebuyer demand. All you have to do to see this is look at Lennar, the nation's second largest home builder. Look at their last earnings report. And if you don't want to look at that, don't worry about it. I made a whole video breaking it down. You can see my real estate playlist. All my real estate videos are in order. Just click the link down below. You can go to mettkevin.com/links, and I'll put a link there for the real estate playlist for you. But fear is one of the greatest issues leading to subsequent cancellations and price reduction demands in their Category 3 markets, which basically ones that are suffering the worst, although all categories of the Lennar markets are suffering. But today, we have three core pieces of data that we've got to talk about that are going to help guide us in terms of maybe where we want to go do some shopping. Now, keep in mind, I will be personally meeting a lot of you real estate agents out there in various different markets around the country, because that's going to be my job with HouseHack, is traveling and studying markets in person. You have to do real estate in person. You can't do it sitting behind a computer. You've got to know the market in person. When I was selling my homes, the 85% of my real estate portfolio, and I started selling them at the end of January, beginning of February, and I sold them through June. I promise you, I saw the crest because I saw it in person. Let me give you an example. I put a house up on the market the first week of February. I have an open house on a Sunday. I get swarmed with 50 to 60 people during that open house in a 1-hour window. There were so many cars on the street, which is usually empty, I couldn't even find a parking spot. I had to walk about 15 houses just to get to my house I was selling. It was a madhouse. Absolutely crazy. Contrast that with June. I put a place on the market, same style of open house, same marketing, multiple properties. I got maybe 5 people. Okay, that was February to June. Just picture now compared to June. Okay, like things are worse now. Okay, but it's that kind of stuff that you can feel and you see it way before it shows up in the data. Now, we are going to talk about the data because the data is important to look at as well, because it guides us to a specific location of where potentially maximum pain is. Keep in mind, if you are a real estate agent and you want me to explore your area, make sure you're part of the programs on Building Your Wealth down below, because in Discord, there's a whole section for agents where you can put basically your business card. Just type it out, put your business card in the certain areas, like the 20 to 30 locations or whatever. And then I'll be able to go through those and say, hey, I'm coming to your area this time. Are you available? Would love to see some properties, love to learn about your market. And then that way we can pick from those for HouseHack, which is accepting wires for the first round with the largest warrants until Friday. If you're accredited, you can go there now. Non-accredited, stay tuned. Okay, so first piece of data this morning, 6 a.m. this morning, we got the FHA home price data. Year over year, we are still up 13.9% on home prices, which is great. But anybody looking at just the year-over-year chart is missing the bigger picture, which is that nationwide home prices in July, I have a bone to pick with why this is July and not like August. But anyway, home prices in July were down 0.6%. That is an annualized decline, folks, of 7.2% on top of what we've already seen. We've already seen nationwide home prices come down 5.5%. Now we're declining at a rate of 7.2%. Just adding those together, assuming the trajectory does not get worse, means we are already spelling out a 12.7% reduction in home prices. Now, I know many of you are going to look at this and go, thank God, maybe I'll finally be able to afford a home. Don't get terribly excited. We are not going back, in my opinion, to levels that we saw in like 2011, 12, or 13. We're probably going back to pre-pandemic levels, maybe even lower than pre-pandemic levels because rates are so ridiculously high. I just got an update that Neil Kashkari is coming out squashing what Charles Evans said this morning. Neil Kashkari saying we're not going to make the same mistake as last time and we're going to keep rates higher for longer. All that means is more permanent damage to the real estate market. That's all it means. Now we're going to talk about specific areas as well and some other data sets that we really need to address. But here's what you got to know. Right here, this chart. This chart tells us what home prices did and where these things happened the worst from June 22nd to July 22nd. Let me actually pause there for a moment and just say, is it not ridiculous that this housing price data doesn't actually come to us until 2 months later? How stupid is that? This is like such lagging data. Now it's still useful because we're going to look at where the pain is in different markets. But I'm telling you, if you're looking at this to guide you for home prices, it's already way worse than this. Here's the way to know what really is happening. Boots on the ground. You pick up the phone, you see a 3 and 2 that last month sold for $400,000. You call the listing agent on a 3 and 2 that's a similar square footage that just went into escrow. Okay, so one closed last month, let's say for $400K. You find the same one that's up for sale again, similar condition hopefully. You call up that agent. Go, hey, or have your agent do it. It's usually easier when agents do it. Hey, just curious, your house over here on Creshire, did y'all get close to ask? I see you're asking $389. And if they tell you, oh, wow, we had so many offers, we went over, then that's a good sign that maybe home price declines have stabilized. If they say something like, I can't tell you exactly. Okay, yeah, no problem. I don't want you to have to tell me exactly. That's fine. I respect that. I mean, if they tell you exactly, great, but just keep asking questions, right? Hey, just wondered, did you have a lot of offers? Was it really competitive or has it slowed down? Oh, yeah, it's really slowed down a lot. Oh, so what, maybe you got one offer or 2 offers or something like that? Yeah, I just got 1 offer. Oh, okay, so safe to say maybe not full price, but close, right? Yeah. Okay, well, they just basically told you they got $375, okay? Now you can measure a decline. You have to know how to talk to people, okay? Basic real estate. Real estate is people. You have to respect people. You have to honor people. You have to be physical with people. I don't mean beating them up, okay? I mean you gotta meet people. You gotta shake hands. That's real estate. Stocks ain't that. Stocks is 27 different monitors and the sticks, okay? Different world. Anyway, that said, where's the pain? Right here, folks. Here we go. Let's see what we got. So the U.S. as a whole declined at an average pace of about 7.2% on a monthly basis in July. But look at this, folks. The worst out of all of them, the Pacific and the New England area. This is really interesting because it's really implying that the most damaged locations are actually the coastlines. So I like to write these things down. Coastlines most damaged, which is interesting to me because coastlines are the most desirable, generally, areas of land mass that we have in America, especially Southern California coastline, which don't worry, we're gonna be bashing on California in just a moment. But there is nowhere like Southern California that has the weather like Southern California in the United States. That's it. The only place in the entire United States that has the Mediterranean climate, also known as the chaparral climate, is the southern coast of California. That's it. Not inland California, not central, not northern California, not anywhere else in the United States. You want that weather, SoCal. Coastline, that's it. But this is actually where you're seeing some of the damage. Some of the highest damage is along the Pacific. And we'll talk about specifically some of this in some areas. But after that, the next most damaged area appears to be the mountain area here. So I wonder if this would be considered like Utah or like parts of Idaho or something like that. You actually have the least amount of damage in the east and west north central area. So kind of that upper middle section, that core section there of America, you almost have no housing price declines. I mean, you had larger housing price declines in the month prior, so it's not like you're immune over here, and we expect more damage to happen. But relative to where the declines are the worst declines appear to be happening consistently in the mountain areas and in the Pacific region and the New England areas. South Atlantic, this would be like South Florida. Here's another area that potentially is starting to get hit, although they did have positive price momentum the month before that, month over month. But it does look like potentially that peak has hit. So it looks like you hit your first, like the first area to hit peak was the Pacific. So that was probably the first area to hit peak, and I'm looking at that as the first one over here to turn negative. And then the next ones to turn negative have been New England by looking right here. So 2, east north central 3, west north central 4, and the mountain 5. So these all sort of hit peak next. And then presumably we're going to see peak next over here at west south central, east south central, and mid-Atlantic. It's going to be like your Mississippi and Louisiana and then Texas. Okay, fascinating. So this gives us a little bit about locale. But what else do we know about locale? Well, let me tell you about locale. Listen to this. San Francisco, okay, month over month. This is insane because when you're going down at this speed that I'm about to tell you, you can multiply it by 12 and roughly approximate where you could be after a year. Now, you do not compound this. I'm not going to go through the math as to why right now, but we're just trying to figure out an annualized rate. Annualized rate is just simply times 12. Don't try to get fancy with exponents here, okay? 3.6% is the decline San Francisco faced in 1 month. This is insane, but a 3.6% decline is equal to a negative 43.2% annualized pace for San Francisco. That bubble has popped. But it ain't just San Francisco, which is a big part of the Pacific. It's Seattle. Seattle, folks, down 2.5%. That is a 30% annualized decline. And San Diego isn't immune either. You're almost going down the whole coastline of the Pacific. It's bad. San Diego down 2%, which annualizes to an annualized rate of decline of 24%. Just so you can visualize that home prices are declining, there are 2 important charts that you now need to look at. Number 1 is this. Look, the reality is yes, home prices on a nominal level have barely moved down. This is why we still see year-over-year gains, because look at the chart. Obviously, if you look back a year ago from here, you're going to be higher by that amount. But the point is, this has happened. The trajectory has changed. You see that little inflection point? It's small right now. I told you about it right here, right before it happened. I told you about it right here, and I'm telling you about it right here. That's why you want to be subscribed to the channel. But we've been talking about this since January, this inflection point coming. And there's still time. But I would not be surprised to see a substantial move to the downside here, especially with higher rates for longer. If you want to visualize the inflection point a little bit better, take a look at this chart right here. This shows you a month-over-month decline in home prices. And it shows you that for the first time, all the way since over here in 2011, for the first time, the Case-Shiller has officially gone negative. This is your second piece of data. First, the FHFA data. Now the Case-Shiller is negative as well. That's your second piece of data in this video. Okay, see, chart? All positive, except for here. And if you look at where we got the big gains, look at the big gains, folks. That right there is a bubble. That's called a housing bubble. This was sustainable. And that's why I wouldn't be surprised if we adjust back to not only these sorts of levels over here, but potentially overcorrect a little bit further because interest rates are so aggressive right now to levels of like 2018, 2019, which that is a buying opportunity. That's why I'm creating the Startup House Hack, to take advantage of this buying opportunity that I believe is happening, that I think is a once in a lifetime opportunity. If you could buy real estate yourself, do it. I'm not saying you have to be part of House Hack, But if you don't have the time or the knowledge to handle real estate, I mean, you could always join the courses on Building Your Wealth, Zero to Millionaire Real Estate Investing course, Do-It-Yourself Property Management course, the Real Estate Agent course. You can learn everything I know. So it's like, I will give you everything I know. I'm not worried about you competing with me at House Hack. There are going to be plenty of deals for me at House Hack. I am not worried about that whatsoever. But you definitely want to make sure you take advantage of this real estate cycle. Now, the third piece of data that we have to understand is that 60% of home price appreciation was due to remote work. That's insane. So that means areas like Boise, Idaho could potentially see a complete reversal of that. So let me give you an example. If home prices went up 50% and 60% of those, so about 30% of that 50%, was due to remote work, if remote work plummets like 80%, roughly, we could see home prices fall 24% in that kind of remote work region solely because of remote work. Add remote work, or take remote work, that 24% decline, add to that interest rates, buyer purchasing power down 40%, add to that fear, you're gonna have a devastating reversal in certain Zoom towns. Those are potentially also opportunities. But you have to be careful of something called a real estate value trap. With House Hack, we're only going to invest in high quality areas that will be areas people want to move to no matter if they're Zoom or not. That is critical. And so you have to find those areas yourself. And I'm going to be exploring the country for those. So if you are a real estate agent, join the courses down below, drop your information in the locations that I have listed. And if you want to suggest other locations, there's a discussion forum. You have to be a course member to see access to these. Any of the courses works. And you'll also be able to join me in the daily live streams. But anyway, this is bad for real estate. It's happening and it's getting real. We're just getting the data, the official data here, with a stupid 2-month delay, which is moronic. I've been telling you this since before it happened, because there are ways you can read the real estate market that don't rely on these national statistics that lag so much. Imagine what these statistics are going to say when we get the year-over-year numbers in March, April, May, June of next year in 2023. Combine that with high rates, that's when you have panic. Good luck, my friends.